Hi, hello, good evening, friends. Welcome, one and all, to INTRAZON 2.0, India's largest retail traders online conference. This is Ashok Devanampriya. I am the CEO of Traders Gurukul and INTRAZON, an algo trading company. On behalf of Traders Gurukul friends, I'm really honored to welcome every one of you into this exciting program. It's a privilege to see people joining us in thousands of numbers in pursuit of knowledge. The beauty of this conference is the special theme, which is intraday. 100% intraday models and strategies would be discussed during the course of this 12-day event. My sincere thanks to colleagues, management, and leadership of Money Control Pro for joining us as a media partner and believing in our ability to deliver great value to traders and investors. Let me also thank and appreciate our title sponsor Espresso, one of the leading discount brokers in India, from the family of Sher Khan, who have close to 25 years experience in the Indian equity markets. The speaker for today is Mr. Prashant Shah from Pune. He is the founder, member, and CEO of Define Edge Solutions, a company which develops high quality financial product and research services. He has written 3 amazing books. I have all 3 books in my library. He is a CMT, Chartered Market Technician, also a certified financial technician. My friend Prashant, it's on behalf
Hello.
of the Traders Gurukul family, Money Control Pro and Espresso families, I extend our warm welcome to you into the program as an elite speaker.
Thank you so much. Thank you so much for the wonderful introduction, and to entire team of Traders Gurukul and Money Control and Espresso. Well, it's great to hear.
So friends, today's session number 5 is on the topic titled Line Break Chart Patterns and Intraday Trading Techniques. Sir, please go ahead and excite our audience with your inspiring session. The stage is all yours. Thank you.
Thank you. Thank you so much. So before we discuss this today's trading strategy, see, I'll talk about roughly around 45 to 50 minutes, and I'll explain you a story, behind the strategy that we are going to discuss today, because it is entirely on a new charting technique, which is known as a line break chart technique. So we'll discuss intraday trading techniques using this method. But before that, we'll discuss what this charting method is all about, and what we are going to discuss, what we are going to implement as a trading strategy, what is the reason behind it. So the presentation is in the format of kind of a story, and it's all about backtesting, data study, and the reason behind, because I strongly believe that if you want to trade something, the most important thing is conviction in the strategy or in the method. And to gain the conviction, you need to know the reasons or the logic behind the methods. So that's what I'm going to convey today, and I've tried to keep it as simple as possible. So once I'm done with the session and the trading techniques, then we can discuss your queries. So during that, you might have some queries in mind. You can just type or you just make a note of it. I'm sure by the end of the session, most of the queries will be answered. But even then, we'll discuss all your queries, and if you want to see some live examples, we'll do that as well. All right, so let's begin. So line break chart is a charting method. Now, the first thing is, what happens is, many of times I keep talking about different charting methods like point and figure, Renko, but trust me, this kind of perception where I look every charting method as an opportunity to see something which is not really visible otherwise, or which is not the patterns, the formations, or there is something which is not really easy to capture in the usual charting methods. If I find something like that, I think then I think that how if we can build some kind of trading strategies. Is there any logic? Is there something which is unique? And if yes, then if we can backtest and see the validity. So that has been the approach. And we all are used to trade or analyze candlestick charts, bar charts, which are perfectly okay. They have their own unique properties, and it's a wonderful method, of course. But then there are point and figure charts, which is an oldest Western method, which has got some unique properties. Then there's Renko chart, which is a Japanese method, one of the oldest Japanese methods, which has got some unique properties like diagonal plotting and all. And this is a chart line break, which is also one of the oldest Japanese method, originated somewhere in 19th century. I think there's a story of a rice trader who used to plot charts using this method. It is also known as, if you study the Japanese material, this method is known from, there are different names like 3-step new price, 3-step reversal charts, box reversal charts, etc. But it is widely known as a 3-line break reversal chart. So 3, okay, I'll come back to why 3. But so this is the a charting method which has got some unique properties, and which that we are going to discuss today. So before we discuss the method in detail, let me just explain in a very simple format how these line break charts are constructed. So see these dots. For example, these are the closing prices of daily closing prices. For example, this is a daily chart, and all these dots are daily closing prices. So we can plot a dot chart this way. Now if I connect these dots, I can draw a line chart, right? A simple line chart based on the closing prices. So this is again a noiseless family member. Noiseless charts, the one-dimensional charts are known as noiseless chart. Actually, this noiseless is something which I have been calling them. A lot of in the West, people know it as timeless charts, but I don't think these are timeless. Time is very much there, but I would call them noiseless because they remove a lot of noise from the data in their own way, each method. So for example, this is a line chart. Now instead of drawing the line, what if I connect two closing prices and draw a box, right? So this is a box. This is the distance between these two prices is high, so it's a wide box. And then you have this box. So every time when there is a closing price, instead of drawing the line, I just draw the box, right? So what happens then? This will be the plotting, right? So now it is the same chart. This is a same line chart, right? But now how it looks, it looks like this. So this is a box chart that way. Now let's color it. When it is bullish, it's a green box. You can call it candle. It's a green candle. And when it's bearish, it's a red candle. What's the difference? It is different from the usual candlestick chart that we use, because now we are connecting the closing prices, and we are drawing the box by connecting the two closing prices. Now let's do one thing. Observe these lines. Now let me take a pen. See, this line, this portion is within the candle of the previous candle, right? That body is within the body of the previous candle. Same way, you can see this, right? So what happens is, here price went up and then it remained there only within the previous body of the previous candle. Actual movement is from here, from the bottom of this. Sorry for this kind of drawing, but so the point is, when a body of a current candle is within the body of the previous candle, the data is actually it's a sideways, it's moving in the same range. So that data is not really relevant, it's kind of noise. How if we remove that? So if we remove them, then what will happen is there will be a vacuum, there will be no data. So let's club this and let's remove this vacuum, let's remove this blank area and connect these lines. This is known as a line break chart. This is a method of plotting the line break chart, right? So here we call it one line break chart because we are simply connecting the closing prices, and as soon as price goes below the previous bottom of the previous candle, we call it we plot the reversal. So this is how we plot the one line break chart. So what happens in the line break chart is it's we plot it using the closing prices, and instead of line we plot the chart in this format, in the format of boxes. Now why line break? See, unfortunately this box is known as line. I don't know why they called it line, maybe because that is how they used to draw it, the thin line. But now in this format it is being drawn, and people call it line. So it's actually a line, single line will be plotted when there is a continuation movement and then there is a reversal line. So in the 3-line break chart, what happens is we plot the reversal line only when price falls below the 1, 2 and 3 lines, right? So for the continuation chart, just like point and figure, for the continuation move, there is no criteria. You keep on plotting the lines as good as and when price is going up. For example, it's a bullish trend, and when price falls below the bottom of the lowest point of last 3 lines, then we plot the reversal, right? Same way, these are the 3 lines. If price goes above the high of this high point of the last 3 lines, then we plot the reversal, and this technique is known as a 3-line break chart. So why 3? So we kind of remove the data or remove the noise from the data. Let me show this from example, using an example. Now, so this is a box which is known as line. So if 3 consecutive bullish lines are formed and then a new bearish line is drawn, only if price falls below the lowest point of last 3 bullish lines, right? So the lowest point of last 3 points, if price falls below that, then we draw a bearish line. Same way, if price goes above the highest point of last 3 lines, then we plot a bullish line. Let's discuss an example for a better idea. For example, price is trading, let's say at 100, it goes to 101, we draw this box known as line. Then price goes to 104, we have a big line. Then it goes to 105, another bullish line. Now we'll continue to plot these bullish lines unless price falls below the bottom of the last 3 lines. So in this case it is 100. So if price falls below 100, then we'll plot a strong bearish line from here. Price goes to 108, so another white line. Now our reversal is at 101. If price falls below this, then we will plot a strong bearish line. Then 112, now our reversal is 104, below this, and price goes below 104, we have a strong bearish line. So now if price continues to fall, we'll if it goes down, we'll have another bearish line. Now there is, for the bearish line there is no criteria, but for the bullish line, if price goes above the highest point of last 3 lines, then we will plot the reversal. So what is the highest point of last 3 lines? It is 112. If price goes above 112, then we will have a bullish line drawn from here, right? So it goes above 112, let's say at 114, we plot another bullish line. So this is how we plot the line chart, line break chart. And this is an example of a line break chart, how it looks. Now just take a pause and think about it. This chart, what if I tell you that this chart is making a line chart more objective? If you read the book of Martin Pling, or many authors have repeatedly told that if you use the line closing based breakout or closing based formations, they are more effective. And I totally agree. With all my experience, I can totally say that when you trade closing price based chart or the formations based on the closing prices, they are very effective. But in the line chart, uh, there is a kind of subjectivity, or you may not know, right? I mean, it's very difficult to design or define the patterns on the line chart. Of course, it has got its own properties, but the same chart is being converted in line break chart. You must have understood it now. And now what happens is we have these lines which we can define. Say, let's say this is a wide line, this is a narrow line, right? There are lines and there's a bearish line reversal. So we have these criteria for reversal. We know exactly when the price will reverse. For example, price is here and the reversal criteria is here. So we know that it's a very wide reversal level, and if it reverses, then we'll have another bullish line, right? So there are advantages and disadvantages of this method, but it is objective. That's a very, very important thing. And because we are using closing price and there is a formation based on that, and we have these objective patterns, they are very, very I mean, objective in nature. So if you plot let's say Nifty chart on a daily basis on 3-line break chart, it will look like this. But now I think you can simply understand the chart. This is a strong trend, this is a strong downtrend, right? And same way, I mean, now you understand why those bearish lines and why those bullish lines. When you have this series of lines which is like continuation, when you have this narrow lines, wide lines, what happens is in the strong downtrend, strong trends, you will have this series of wide lines, narrow lines, followed after each other. So that's a sign of strong trend. And I'll explain some patterns how to read on these charts. But let's again understand what is the reversal price. If this is a bearish line, if price goes above the highest price of last 3 lines, then it is a bullish reversal. If price goes below the low point of last 3 lines, then it is a bearish reversal line. So what are the properties? Here we have the body of a candle is difference between open and close, right? In usual candlestick chart. In line break chart, the body is line, which is a difference between 2 closing prices. That's an important property. Do we have this available in any other charting method? No. If that is the case, then this becomes a unique property of this chart, isn't it? And if that is the case, then we should see, can I utilize this? Can I use this in my trading and investment? So there are more properties, and which is that the lines are not divided in the fixed length of boxes, unlike point and figure or Renko. So this sets this technique apart from them, and this is a unique thing. Which so this being a noiseless family member, we have some different properties which we can think of exploring. So and length of line would vary as per the trend, isn't it? If it's a very strong closing price, then we'll have a wide line. If it is a very narrow difference, then we'll have a narrow line. But the moment we get a line, a reversal price changes, right? And I would call them algo friendly because these are totally objective. For example, if I say I'll buy today based on the bullish line, I'll buy at today's closing price. If I exit tomorrow at the closing price. So I have a clear entry exit prices, and for example, change of line is a formation which we are going to discuss, but all these are totally objective, and that's why this technique can be very algo friendly. We can define a lot of models, automated or algo trading models based on this charting method. Actually, the best advantage of the noiseless chart itself is they are objective in nature, and that's why I keep talking about them, because I soon realized that in the business of trading, it is very important to be as objective as possible. Otherwise, you can't really, you have lots of knowledge, but you can't really implement, then there's no point. What you can implement is which can be defined clearly or which has more objectivity. All right, so all these noiseless charts has some kind of unique properties to offer, and Now here with the line break chart, when stock rise or falls significantly, the length of line will be big. I'm repeating this point because it's very important in the strategy that we are going to discuss. Now, if stock went up or down by a smaller value, the length of line will be small. See this. So this is a very significant price difference because the length of line is wide, and here it is a ordinary change in price because the lines are kind of narrow, or they are kind of normal. Now, when the price, let's call this the though this is also closing price and this is also closing price, a line is a difference between two closing prices. Let's call this a high price and low price of a candle. Okay, so if the price line is bullish, then this will become a high price, and a line is the previous price will become low price. So a current closing price becomes high price of that line, and the previous closing price becomes low price of that line. If line is bearish, then current price becomes the low price of that line, and the previous closing price becomes the high point of that line. So now observe this chart, which is this is a line chart. Now this phase A is kind of volatile, right? It is a downtrend, but it's a volatile. You see these white lines. Then this phase B is kind of narrow movement, right? Phase C is a strong, smooth uptrend, and the corrections are also kind of shallow, and this is a strong uptrend. This phase D is also kind of sideways, right? So these are the or this is kind of sideways and volatile in uptrend. So these are different phases which we can observe on line chart. Now let's see the same thing on line break chart. So this phase A, which is downtrend and volatile, but we have a very clear formation. Phase B, which was kind of sideways, but there was a deep correction. So lines itself are not much. So you don't have a lot of data to, the lines doesn't get plotted. So if you're trading based on this chart, you'll automatically, your number of trades will be reduced. That's an advantage. Phase C, which was a clear, smooth uptrend, you have a series of bullish lines. There's no bearish line, right? So you can play this well. And then phase D, which is kind of volatile sideways, here you have kind of expanding formation, but the number of lines are kind of in control. Yeah, we have in any type of chart, or actually in the market itself, on any time frame, there is a cycle of smooth trend and the trouble, which is inevitable on any time frame, any instrument, and you will keep getting a smooth trend followed by a trouble, which is kind of volatile, or things like that. So that keeps on happening. This will happen. So this will happen here also on the. So using noiseless charts also, what we are trying to do is we're trying to reduce that trouble. We cannot totally avoid that, but we are trying to deal with that trouble and trying to reduce the pain. Now here, when we say analyze that chart, how we can make it objective, or what can help us in defining the different setups. See, these are series of 5 bullish lines followed by a 2-line correction. Then we have series of 13 lines, right? So we can always calculate the lines, and we can make that move more objective. Can we do this on line chart? No, right? Here now I can perhaps define the move. I can say that it's a 5-line bullish move followed by a 2-line correction, and then followed by a strong 13-line strong trend. Think of it. This all makes it really interesting. So when I was doing this, in fact, I wrote a research paper on this charting method for, and that was well accepted, because when this charting method was invented in 19th century, let's say, it was a time when there was no computer. This technique then, I mean, at that time, it was very advanced, because plotting something on the chart, chart itself was very advanced. But today, this could be a very simple thing. Fine, I mean, we have this kind of reversals, and we can see these simple lines. So we also get to know in a way the trend on candlestick chart also, or any other charting method. But then can we use technology or the things which we have today, and see what can we do? Can we plan some advanced technique on this ancient method? So that was a thought process, and I found that this is very objective, and if it is objective, we can totally back test it, right? I mean, it should be we should be able to see different trends and see how the markets behaved or how it performed in the past. So this series of strong lines shows us a strong trend. For example, this is a strong bullish trend and strong bearish trend. So we can totally trade this phase very effectively. How? If we enter based on some bullish line and don't exit unless it is a change of line, then it looks really good. I mean, I can ride some strong trends and I can make a lot of money, right? Same way, it's a strong downtrend. I can ride these strong downtrends unless the line reverses. I can make a lot of money. It looks like that. Well, it's not that. It's not that easy. And how will we get to know about that? It's if we can backtest this, right? So I think to explain or to study the line break chart method, because the entry and exit rules are so simple, we can simply backtest, study the data, and then talk whether it is workable, whether what we are discussing is doable, right? So that technique is what we are going to discuss today. And the time frame is usually daily chart is what I always recommend, even for the positional trades, but we are also going to discuss about weekly and monthly line charts. So this technique is applicable on all time frames: daily, weekly, monthly, yearly, intraday, 1 minute, 5 minute, 15 minute. So any time frame which you follow for candlestick chart is applicable on line break chart also. But roughly as a rule, I recommend daily time frame. Of course, weekly and monthly are also doable, but they come with kind of a disadvantage. And on intraday, I recommend 15 minute. Now see, this is the data up to 2019 only. Sorry, I was kind of a bit lazy. I could have inserted 2020 also. So 2005, I calculated the percentage, the number of bullish lines and number of bearish lines on a daily chart that occurred during that year in Nifty. So in 2005, there were about 70% bullish lines and about 30% bearish lines. Now, what was the return on a YOY basis? So it was around 36%. That means a year was really bullish. It was the market phase was bullish, and so the bullish line percentage was high, which makes sense. Same happened in 2006. The returns were positive, about 40%. Nifty went about 40%, and bullish lines were around 79%. So almost only bullish lines, mostly, almost around 80% bullish lines. Same in 2007, around 70% bullish line. In fact, 2007 is kind of interesting because till I guess November, there were more bullish lines, much more than this, and then there were some bearish lines later. In 2008, 66% bearish lines, and market was about 51% down. So in all this data, you will observe that when there's a bullish phase, you have more bullish lines, and when there's a bearish phase, you have more bearish lines. So which is kind of obvious, but can we use this information and in our trading, right? So in bullish phase, you'll obviously have more bullish lines, and in bearish phase, we'll have more bearish lines. So can we trade based on change of line? If bearish line occurs, I'll exit. Otherwise, I'll remain. I'll buy something and I'll remain in unless the bearish line occurs. So that data tells us that it can be very effective trading methodology. So we'll study that. But before that, then a lot of people who use line break chart. One more thing, whatever I'm going to discuss today is totally my work. It's an original work, and you will not find anywhere else. It's totally my research, and a lot of people use this method, but I strongly believe that they haven't understand the potential of this method. They use traditional methods of analysis on this chart, which is totally okay. For example, I have drawn this trend line, and here there's a breakout. Of course, it's a good valid breakout. You can call it kind of cup and handle or kind of inverted head and shoulder. They will look bit different here than what we see on candlestick chart, but it is a similar kind of formation. For example, here we have a support at point A, then there's a trend line breakout at point B. Same way, it's this point C is triangular formation, and there was a breakout which we can trade. This point D is a rising trend line, and in this chart you can see, sorry, in this chart you can see this. This is a candlestick chart. You can see a bottom, and then downtrend, and then consolidation, and this small consolidation at point A. I'm sorry, I think I missed that chart, online break chart. Anyway, this is BHL. See this at point A, this is inverted cup and handle, or this is a strong consolidation. This is expanding pattern at point C. This is Fibonacci retracement. If you follow this kind of method, that is also possible on line break chart. So the point is, all these traditional methods are possible on line break chart also. This is kind of lower high followed by a strong downtrend, and this is a strong uptrend. So these techniques are applicable here also. I mean, that's it. You can follow all those methods here if you understand the formation of these charts. But now let's take this further. Okay, I'm talking about same HDFC chart here. It is a strong downtrend. This was a support. This is a triangular kind of formation, and when there's a pain, then there's no the candles are less. You can see this series of narrow lines. That's a very interesting aspect, because in that case the lines are very narrow, and you don't get many trades. This is kind of harmonic pattern, which of course you can apply on this charting method also. So all this is possible. Now let's talk about what unique thing what the line break chart has to offer, and what I recommend to trade, which can improve your decision making, and which can help you to trade any kind of pattern on line break chart. You can also plot indicators on line break chart. We'll discuss that. So now the basic thing, when after a series of bearish line, or after a bearish line, when a bullish line appears, let's call it bullish change of line. Same way, after a bullish line, when there's a bearish line, let's call it bearish change of line. So a first thing which can come in mind is, what if I buy at bullish line and sell at bearish line, right? So your point A is bearish change of line. All these point A's in the chart are bearish change of line. This point B is a bullish change of line. Okay. So what if my method is, I sell at A, I buy at B, correct? And now this is, because this is objective, I can always backtest. So let's see the backtesting rules. What are the rules? COL is change of line. So buy when there is a bullish change of line, exit when there is a bearish change of line, short when there is a bearish change of line, cover when there is a bullish change of line. So let's backtest. So in backtest, we'll see a number of trades, success ratio, risk reward, and the major factor that I always look at in any kind of backtesting is expectancy. In my mind, I think it is the simplest, most thing which can tell you whether your system is profitable or not. So here it is success ratio multiplied by risk reward ratio minus failure ratio. It is expectancy. This formula is this was explained by Ben Tharp in his book on position sizing, and a lot of wonderful books that he has written. So it's a very wonderful dependable formula that way. And the parameter is, it should be positive. If expectancy is positive, then you have made money based on backtesting in that system. So this is a backtesting result of the method that we have just discussed. Buying on bullish change of line, selling on bearish change of line, shorting on bearish change of line, buying on bullish change of line. So this I have done on all Nifty 500 stocks, over 20 years. So we have a good sample size of about 35,000 trades. The hit ratio has been around 40%. Now, this first is the bullish trade, and the second is bearish trades. Now, the first in the bullish segment, the average return is positive, risk reward is good, and expectancy is almost about 0.5, which is good. And this is very close to practical trading, because minus slippages, some slippages can be there, but otherwise it is almost close to very practical thing. And all experienced traders will agree to me that 40-45% is a very decent ratio if your risk reward is above 1:2. All other things that people talk about is nonsense. This is actually a practical thing which you can achieve in trading, and you can really make good money if you achieve this practically. All right, so this method looks good, and the bearish system has got negative expectancy, that is not working, or that it seems like it doesn't work. So some observations are: this data has significant sample size to make result dependable. Expectancy is positive and numbers are good in bullish trades, but bearish trading is not profitable. Another thing is, because if I just divide this number and calculate the number of trades in a particular year, it will be about 5 to 6. So if that kind of thing suits you, then this can be a very good system for investment, isn't it? And another way, if that number doesn't suit you, then you can reduce your universe size and you can apply some kind of filtration. But one more thing, we see that the number of the expectancy of bearish trades is not good. But you know what is the major reason of that? It's not about system. What if I change that this particular system, a bearish trading system, in the year 2008? Do you think expectancy will be still negative? No, right? Because the year was bearish. There were about 67% bearish lines in that year. Naturally, my system will be profitable. So the message is, over last 20 years, India has mostly seen a bullish market. Sorry, this data is from 2005. So over last 15 years, of course, India has seen only bullish market, mostly bullish. There are some bearish years, I mean, couple of bearish years, some sideways market, but mostly it is bullish. And that is why whenever you will backtest, not only on this, anything else, it is kind of bullish biased. So we have to consider that factor. And why it is important is because we don't know what will happen tomorrow. What if tomorrow we see a strong bear market? India has never seen a long-term bear market. What if that happens? I'm not saying it is going to happen, but what if that happens? We have to consider those things. And that is the reason why bearish trades is not having encouraging result, but that doesn't mean they are not effective. All right. Now, the success ratio, of course, I have said this earlier, but success ratio is around 40%. And I said it is good. That means 60% of trades will be losing trades, right? Does that mean the system is good? Because actually your success will not be determined by those 40% trades, because that's just one part of it. What will determine your success is what you do in those 60% trades. Do you stick to the system and exit the trades in loss also? If you can do that, then you can really do well in trading. But that's a very important aspect. How you manage your failures determines your success. And I think we can improve the hit ratio of this strategy for any strategy. And this is for the people who claim 70, 80, 90% hit ratio. Actually, you can achieve that on any trading system. You want to see a good hit ratio in the method that we discussed. So let's change the exit rule. Let us exit immediately on the next line itself. So I buy based on the bullish line. If I get another bullish line, I exit, right? I'll make money, right? So what is the hit ratio in that case? Almost more than 80%, almost 82% each side, right? So of course my hit ratio is amazing. What is my expectancy? It is almost, I mean, there's nothing which I'm making, right? So hit ratio is wonderful. Did I make money? Not really. The hit ratio was 40%. Did I make money? It was really great numbers. So the message is, you can improve the hit ratio by compromising on your, by making your exit system very aggressive. You have a great hit ratio, but you don't make money. The people who make money have learned to digest the 40-45% kind of success ratio by improving their risk reward ratio, and by that improving their expectancy, because money in the market is made by improving the risk reward, not by success ratio. So of course, I've already said this, high success ratio and high risk reward does not coexist. So that's a very I mean, you have to accept it today or maybe later, but that's a fact. The success ratio of any strategy can be increased by compromising on risk reward, right? So I've already explained that. So let's move to some more patterns. So we have discussed that change of line can be a very good formation. Now, can we improve the results further? So I have studied some more patterns which we can clearly define on line break chart, and we'll study their results also. So there is this, for example, this is a swing high. You have a series of bullish lines, and then as soon as you get a bearish line, the high of that line is a swing high pattern. Same way, when you have a bearish lines followed by a bullish line, the low of that bearish line becomes a swing low. Okay, so it is marked as soon as we get a reversal pattern. So this is a swing high and this is a swing low. So if this is a pattern and this is a swing high, now if price goes above this high point, we'll call it bullish swing breakout. Okay, and if price falls below this point, we'll call it bearish swing breakout. It is similar to what I have explained in Renko chart while explaining that method, but it is more or less same. But here, because the nature of plotting the lines is a bit different, the patterns and the entry levels will vary, but the formation is kind of similar: bullish swing breakout and bearish swing breakout. I hope it's very simple. I hope you understood. So let's see the example. This is a chart of Reliance. This is a bullish swing breakout because price went above the high of this previous line. Same way, this is a bearish swing breakout, and here then we have a series of lower highs. This swing high was never broken. Here there was a swing high, and this is a bullish swing breakout. This was a swing low which was not broken, and you have another bearish line. So in this chart, you have one bullish swing breakout. Here there's a bearish swing breakout. Then you have a bullish swing breakout, and there's no bearish swing breakout. So this looks very simple, very clear, and it is kind of crux of a lot of systems that we also study on usual charts, like the swing breakouts. This is completely made objective. So let's test this. What are the rules? Buy when there is a bullish swing breakout, exit when there is a bearish swing breakout, short when there is a bearish swing breakout, buy when there is a bullish swing breakout. Let's see what are the results. So you have almost 10,000 trades each side over 15-16 years. The hit ratio is somewhere around 40%. The expectancy for bullish trades is really high. It's above 1. Your risk reward is amazing. Average return per trade is brilliant. But your bearish trades, I mean, the bearish trades are not working, right? So as expected, the number of trades were reduced because now we are not simply changing based on the change of line. We are trading based on the swing breakout. So number of trades reduced. The risk reward ratio, return per trade, and everything improved for the bullish trades. Risk reward ratio improved significantly for the trailing method stop loss, right? Because in the bearish swing breakout, we trail the stop loss now based on the bearish low. So that improved. But numbers are not encouraging for bearish trades. We have to do something here. Now, what if we combine both these methods then? Swing breakout plus change of line. So buy when there is a bullish swing breakout, exit when there is a bearish change of line, right? Short when there is a bearish swing breakout, and cover when there is a bullish change of line. What happens in that case? So what happens is your number of trades increased slightly. Your you have to compromise on the expectancy and returns on the bullish trades, but your expectancy improved. At least it was positive in bearish swing breakout. So if you enter based on the bearish swing breakout and exit based on a bullish change of line, your expectancy will improve. So your system needs to be your exit method for the bearish trades needs to be bit aggressive comparatively.
Hi Prashant, your slide disappeared.
Yeah, is it visible now?
Yes, better now. Go ahead.
Sorry. Okay. So what happened in this tweak? The number of trades increased, expectancy and other numbers of bullish trades are compromised, but result of bearish trades improved. So of course, if we trade based on some other aspects, like we use other patterns, other tools, other charting methods, indicators, trend line, etc., then we can perhaps improve the performance further. But we can't backtest it, so we'll not talk about that. So whole idea is aggressive exits. So exit based on change of line is aggressive method. We exit immediately as soon as the line changes the color. Important learning is overall performance is better for bullish trades when exit method is not aggressive. When we ride the trend and we give up on our desire to exit early, then we can perhaps make good money in bullish trades. Exit based on swing low and trailing stop loss would give you better returns. But for bearish trades, you need to have aggressive exit. So this is our learning from the data that we have studied. Right now, let's take this bit further. Your performance can be improved if you have higher low, lower high formation in change of line. For example, this is point. All these point A's are bullish change of line, and these point B's are bearish change of line. Here it is a higher low, here it is a higher low, here this is higher low. So this is a strong trend. Here this is lower high. So you trade based on change of line, bullish change of line, only when there is a higher low. You trade based on lower bearish change of line only when there is a lower high. So that's a kind of system, right? And that can improve your result. But then I spent a lot of time on this method, and the change of line could be very interesting, but that I segregated it in 4 different methods. I call them 4-line reversal patterns. Yeah, so this is what I have discovered. But before I explain the segregation, now let's try to understand what these 4 patterns are. So I call this bullish trend reversal. So in change of line, after consecutive 3 bearish lines, if you have a bullish line, it is a bullish trend reversal. Same way, after 3 consecutive bullish lines, if you have a bearish line, it's a bearish trend reversal. So this is also a bullish change of line, but what makes it different is you had 3 bearish lines before the bullish line. There was no bullish line in between. So 3 bearish lines and a bullish line is a bullish trend reversal pattern. 3 bullish lines and a bearish line is a bearish trend reversal pattern. Why trend reversal? It tells us that there was a strong bearish trend and there is a sudden reversal of the trend by that strong wide bullish line. Same way, there was a strong bullish trend followed by a wide bearish line. It's a strong bearish trend reversal. Yeah. So this is an example of bullish trend reversal. A bullish line appeared, bullish change of line. This is an example of bearish trend reversal. So now see this. This was a bullish trend reversal. Just a moment. And this is also a bearish trend reversal. Right? Here in this case, it is not a bullish trend reversal because there was a bearish line in between. Correct? So that's a key difference. Here there was a 3 bearish lines followed by a strong bullish line. So that's why it is a bullish trend reversal pattern. This is not a bullish trend reversal pattern. You need to have 3 bearish lines before a bullish line. So that's a key difference, and I call it bullish trend reversal. Now, why I call this? Now, so we can have a trading rule: buy when there is a bullish trend reversal, exit when there is a bearish change of line, short when there is a bearish trend reversal, exit cover when there is a bullish change of line. We'll test this rule, but before that, let's try to understand other patterns. This is a bullish shakeout when there is one bearish line, two bullish line followed by one bearish and then a bullish line. So when this kind of pattern you see, it's a bullish shakeout. So it was a series of bullish lines, but there was one bearish line in between. It's a shakeout. Let's call this bullish shakeout. And two bearish lines followed by a bullish line and a bearish line. This is a bearish shakeout. Okay, so we have segregated this pattern. For example, see, this is a two bullish lines followed by a bearish lines, followed by a bullish line and a bearish line. So this is a bearish shakeout. This is a bearish shakeout. This is a bullish shakeout. Bullish lines followed by a bearish line and a bullish line. So we always have to see last 4 lines. So including the reversal line, you have to see last 4 lines and see the pattern and name the pattern based on that. You have 2 lines, bearish line and a bullish line. So this is kind of bullish shakeout pattern. Okay, now which pattern is this? This is a bearish trend reversal pattern. 3 bullish line followed by a bearish line. Okay, so this is how we have we have segregated the pattern, and we call this bullish the shakeout pattern. So if I want to trade this pattern, the rules can be buy on bullish shakeout, exit when there's a bearish change of line, short when there's a bearish shakeout, exit when there's a bullish change of line. Third pattern is rounding bottom. So you have a bullish line, 2 bearish lines followed by a bullish line. I call this a rounding pattern, but because I've seen in candlestick chart a lot of rounding bottom patterns are mostly like this kind of pattern on line break chart. You have a bullish line followed by 2 bearish lines and a bullish line. So it's a rounding bottom. Same way, this is a rounding top. Bearish line followed by 2 bullish lines and a bearish line. So this is an example of rounding bottom. Bullish, 2 bearish and bullish. This is bullish, 2 bearish and bullish. This is like rounding bottom. Bullish, 2 bearish and bullish. This is like rounding bottom. This is a bullish shakeout. There are no 2 bearish lines. So you have 2 bullish lines, a bearish line, and then a bullish line. So this is like bullish shakeout. Right. Same way, this is like rounding top. Bearish, 2 bullish and a bearish. This is shakeout because you have just one line. This is also rounding top, bearish, 2 bullish and a bearish. So completely objective pattern, and there's no ambiguity. You know, it's a totally segregated between these 4. So the trading rules are buy on rounding bottom, sell on change of line, sell on rounding top, buy when there's a bullish change of line. And last pattern is expanding. So you have these alternate lines: bearish, bullish, bearish, bullish. This is bullish expanding. Bullish, bearish, bullish, bearish. This is bearish expanding. It's very simple and very easy to identify. I've always found this during major tops and bottoms. So this is kind of like bearish, bullish, bearish, bullish. This is expanding, bullish expanding pattern. So there was a fight between bulls and bears. You know, there was a frequent change of lines, and ultimately one party won. This is like a rounding pattern: bearish, 2 bullish and bearish. Yeah, this is a kind of analysis, the failure of rounding top. This is alternate line: bullish, bearish, bullish, bearish. This is like bearish expanding, right? So I guess you can easily see those patterns on the chart. Rules can be buy on bullish expanding, sell on change of line, sell on bearish expanding, buy on change of line. So now see this chart. There are different patterns. For example, bearish, bullish, bearish, bullish. So this is a bullish expanding pattern. Bullish, bearish, 2 bullish, and then a bearish line. So it is a rounding top. Then again, you have a change of color: bullish, bearish, bullish, bearish. This is bearish expanding. You have 3 bearish lines followed by a strong bullish line. So this is bullish trend reversal. Bullish, 2 bearish and a bullish. So it is rounding bottom. And you have bullish, bearish, bullish, bearish. It is bearish expanding. So all these patterns are clearly defined and you can easily observe them on chart. You don't need even my help once you have understood these rules. Or you and me can't discuss that I see rounding top. Do you see a rounding top? That's not the case here. If it is a rounding top, it is a rounding top. It's a totally objective pattern. So maybe you can just take a snapshot of this and try to see if you can identify those patterns here on this chart at the points that I have mentioned. Then of course you can, from analysis perspective also, you can use other tools and trade these patterns. For example, you have a rounding bottom here, then you have a bullish swing breakout, you have this uptrend of this was a higher low followed by a bullish swing breakout, right? You have this strong trend line breakout here, but here before that, here it was a in the uptrend you had a bullish shakeout. Then you have a bearish swing breakout followed after a trend line breakout. So these kind of analysis you can always do. This was higher bottom support, and this is a channel line breakout along with a bullish swing breakout. So all these things you can always analyze. Once you have understood this pattern, maybe you can analyze the charts this way and trade. But if I now divide and I calculate the number of occurrences of in the data, see, because all these 4 patterns that we have discussed are actually change of line. It is a change of line that we have divided in 4 parts, right? If you think closely about it, any reversal can be segregated in these 4 patterns: trend reversal, shakeout, expanding, and rounding. And if I divide the past data and see the number of occurrences, then 68% patterns are bullish trend reversal. Expanding patterns are very rare. They are about 2-3%. And shakeout and rounding bottoms are around 15%. This is about bullish pattern. In the bearish pattern, trend reversal patterns are 70%. Expanding are around 2%, rounding around 10%, and bearish is around 14-15%. So that's a total data. Now let's see what happens if we backtest. So if there is a bullish trend reversal, now here in this case I have backtested these patterns, and for the bullish, these are the bullish patterns, and the exit condition is bearish change of line. So this is the data. The number of trades are most in the trend reversal, and you see these average returns, they are good, the risk reward are good, and expectancy is also positive. The expanding pattern, though very rare, it has got a good expectancy, right? Of course, shakeout is also good. So these rare patterns are also having good expectancy and risk reward ratio and returns. That means if you come across this kind of pattern in stock, you can plan a trade. You can trade based on change of line itself. So calculate your risk. If the risk based on change of line is affordable, we can enter based on this. So it can be a good. So for example, if you are investing in a stock, if I simply tell you that you trade based on change of line, so there are so many stocks, and there can be so many bullish change of line patterns. How can you practically trade all of them, right? We saw in the data that there were 35,000 occurrences. For example, in a year, if you have 1,500 occurrences, you can't trade 1,500 stocks, right? So you need filtration. So these are the patterns which you can filter. Now in change of line also, if you have a bullish shakeout or expanding pattern in few stocks, and then you have some other confirmation, for example, in the line break chart only, if you see a good uptrend, or you have something on the candlestick chart, or if you have a good fundamental information of that stock, you can trade that stock. If your change of line is affordable, you can take that risk, and perhaps this number will improve. And if you trade straightway, then also this number is very encouraging. Now, what happens in the bearish trades? We know that the expectancy of bearish trades is not, it has not been good. But if we see it pattern wise, then rounding top looks kind of okay. I mean, if we see rounding top in the downtrend, at least it has got some positive expectancy. And other patterns, maybe shakeout or expanding, maybe we can apply some filters. We only trade them when there is a strong downtrend that we see, and we improve on this ratio. Naturally, the bearish patterns will not have a good ratio, because as we have discussed, mostly we have seen the bullish market. Now let's do this thing. We have tested these patterns based on the change of line pattern. What if we change the exit method and test it based on the swing breakout? So we have our exit method will be kind of slightly we'll end up riding the trade. So you can see that expectancy improved significantly. The risk reward and average return are also very good. So in the bullish trades, the message is that whatever you do, you can do well. If you can ride the trend, you can really make good money by benefiting from the risk reward ratio. So now we have this data on a weekly and monthly chart. See, this is the bullish data. About success ratio is about 35 to 40%, but the risk reward and average return is really high when you go on the higher time frame, weekly and monthly. It's not very easy to follow, let me tell you, but the data wise, if you test the past numbers, it is very encouraging. But of course, monthly though I would not recommend really, because it's not that easy, because at times your stop loss would be very, very far. But weekly is tradable. It is like trading weekly candlestick chart. Now what happens is, how many people can practically trade a weekly chart? I'm not sure about that, because at times the stop loss is very far. Yeah, based on the subjective methods, you can check weekly charts, you can see the trend line, candlestick formations, and perhaps trade. But when it comes to objective techniques, weekly is not really easy to trade, but it shows us that the numbers can be really good. Now, before we discuss the trading techniques, here are some lessons from the backtesting or the data that we studied. Of course, what occurred in past can be different for what is there in future. But backtesting is a tool that can develop our market understanding, right? We analyze what has happened in past. What happens if we have an aggressive exit method? What happens if we segregate the pattern in different formations? What we can do? So of course, as we discussed, there are last 15 years in India, so patterns are bullish biased, and there are always unknown unknowns. But one important learning could be exactly opposite of what we do for bullish trades is not really a good idea for the bearish trades. You know, the methods should be different for long and short, and that can improve your trading significantly. So for bullish patterns, entry and exit based on swing breakouts are very effective, and bifurcation of reversal patterns can help us in filtering the stocks based on the type of the pattern, right? For example, setups such as combination of shakeout, expanding, we can design them. And aggressive exits for the bearish setups are very beneficial. And for the bullish trades, higher the time frame, better it is. And aggressive exits are not useful for bullish trades. So these are our learnings. And that way, I'll give you from based on this, I'll give you some rules for intraday trading. So because our theme is intraday trading, so I'll focus on that. But the rules can differ based on what we do end of the day or on a higher time frame. So the time frame that I recommend is 15 minutes, and the methods that I recommend for bullish patterns is bullish swing breakout, bullish trend reversal, and the rounding bottom. These three patterns or the combination of these three can be very, very effective. And the exit, what I recommend is based on the bearish swing breakout. So I have a very totally objective method based on a 15-minute line break chart. Trade based on one of these patterns. If there's a swing breakout, if there's a bullish trend reversal or a rounding bottom, not simply based on a bullish change of line. Your results will improve, and I recommend staying in the trend unless there's a bearish swing breakout. Same way, for bearish patterns, these are the four patterns which are very useful: bearish swing breakout, bearish shakeout, bearish expanding, and rounding top. These are this combination of these four patterns, but the exit has to change. The bullish change of line, or if you get 1:2, you exit, and that way your expectancy of bearish trades will significantly improve. I'll show you the backtesting of that also while discussing the queries. But this is what I strongly recommend, and this is well tested, well studied, well observed pattern just for your knowledge. For example, this is a line break chart. I'll remove the moving average line. This is a 15-minute chart. You have this bearish shakeout, you have this rounding top, you have this bearish trend reversal, you have this bullish trend reversal. In fact, in trade point, you have all these patterns clearly defined. You can have a scanner based on this, and you can create systems also, and you can backtest all this as well on any universe that you want, right? Of course, there are many things on line break chart. This is just one portion of it. You can do based on length of lines and projections. You have these kind of pattern also, and you have projections also. But maybe some other time. But what I have just discussed is good enough for effective intraday trading. This is applicable on all stocks, including the indices, Nifty and Bank Nifty. So I'll quickly show you the result of that as well. So I think now we can open for Q&A. But before that, I think there could be some announcements.
Yep, sounds good. So, friends, the official partner for the INTRAZON 2.0 event is Espresso, the leading discount broking arm of Sharekhan. They are the early adopters of online trading system in India. The uniqueness here is there shall be no brokerage for loss-making trades. They will charge brokerage only for profit-making trades, and there is zero brokerage for investing models. This is an effort to find the right value proposition for the new generation of traders and investors. Okay, we can move on to the subsequent slides, Prashantji.
Sure. So first of all, if there's any query, we can always discuss.
Prashant, little back. Wow, stay there. So friends, here is an update about INTRAZON. One slide ahead. Yep. So which is the Amazon of stock trading strategies. The organization has close to about 10 strategies listed on the portfolio. This commands a minimum ticket size of 25 lakhs. The salient features includes 100% algorithmic strategies, 100% transparency in risk and return. All are back tested, validated, zero optimization. Monte Carlo simulations have been successfully completed. Zero manual effort, cloud system, plug and play strategy as a service with no exit restrictions. Okay, these are fully automated algo strategies for traders. You just plug in and you're done for the you can move on with your life. So for more details, you can log on to www.statazon.in. You can always go to the contact section and fill in the details. The relationship manager will approach you. And the beauty here is very simple. The mission is to grow the money, doubling the money every 3 to 4 years, and the dream is to achieve a 26% CAGR, which is officially 10x in 10 years. So next slide, sir, please. Okay, so friends, here is the free quant Panini strategy for all. This strategy has been quite successful this year. Overall, this has made about 62% so far, with 17% coming in last quarter. And this quarter has been fairly well. This month, the strategy till date has given about 5% in the real-time basis. We have punched almost about, let's say, about 60 lots of this strategy so far. If you want it, go to the Traders Gurukul website, right top corner, type the word Panini and you will get the course. Subscribe it and you have the course access for free, and you have recording access for lifetime. All right, don't miss the opportunity. And Prashant, over to you.
Okay. So if there are any questions or queries, we can discuss them. And meanwhile,
yes,
I'll just
let me take up questions one by one. Where to get 3-line break charts apart from TradePoint? Is there any other website which gives these things?
It is available on all charting platforms.
Does it is it available in TradingView? If yes, sir, can you show it there once?
Sorry, I don't have TradingView. I don't even know. I mean, but of course it is there. It is of course available on TradingView also and all charting platforms.
Okay, sounds good. Friends, go ahead, shoot your questions. Let me pick up one by one. There was a slide where 5 to 6 trades per year was mentioned. Can you please explain what it means? How is it related to the occurrence and average return?
So it's not about average return. My point was because I tested this setups over 15 years, over Nifty 500 symbols. So when we trade, it is the number of trades is also a very important criteria, because if, for example, I'm trading 50 stocks and it's an objective setup, and if I have a 5 trades per year, then I'll have 250 trades per year. So can I do that? That's an important criteria. So I said, if you can't do this, so in one segment, one stock, there will be about 5 to 6 trades in a year. So if you want to trade this setup, then you'll have to reduce your universe size. That was a message basically, and so you have to plan our position sizing accordingly.
Okay, can this chart be drawn in Zerodha?
Yeah, I guess. I mean, I haven't used Zerodha, but of course it is. It can. I guess every broker will have this charting method. It's a very basic thing available everywhere.
Okay. Is there any real advantage over Heikin-Ashi chart pattern, which is also kind of noiseless chart?
Yeah, I mean, see, I would never actually compare that. Does this will it have advantage over any other charting method? Because I believe each charting method has got unique properties that they offer, and we should know how to take an advantage of it. So there are some good setups based on Heikin-Ashi also, but the patterns that I've discussed on line break chart you can't really see anywhere else, and they are so objective. We've also seen the backtesting results. Then we can perhaps trade it on line break chart, and it's a profitable strategy.
Is this strategy good for options trading also, or is applicable only for stocks? Can you please
No,
move
it
to
is.
the Q&A world?
Actually, this is a good question, because I forgot this point. This is equally applicable on options also, on 15-minute time frame intraday options, and the same patterns that I have explained.
Okay, sounds good. And to understand more of noiseless charts, Prashant, can you please suggest the right books for the audience? Because these topics are new for most of them, so some people have a bit of confusions.
So you can read books by Prashant Shah.
Yeah, probably you can show that book. You can probably show that book in
Okay, I
Amazon.
mean, of course, you can find that on Amazon.
So
This is
friends, if you don't know, a lot of people are expressing their confusions on this concept. Prashant Shah is a very well-known author for noiseless charts. He has written 3 amazing books, one on Renko charts, one is on point and figure, okay, and one new one on relative breadth,
Mhm.
okay. So you can type his name, you get all the information there. So he has been one of the well-known point and figure analysts in the country. All right, so you guys can Google about it, or check those details in Amazon as well. Okay, this is for your information, and let me pick up some more questions.
Hmm.
There is a question. Okay, how do we pick stock for these kind of setups? How are we going to select the stocks?
So I talked about these patterns. If you want to trade bullish patterns, so these are the 3 patterns. I explained each of them: bullish swing breakout, trend reversal, and rounding bottom. If you test stocks in past, these are the 3 good patterns which you can trade. The exit method can be bearish swing breakout. Same way, these are the bearish patterns, and the exit method is bullish change of line or 1:2. You can also see this backtested result on Nifty and Bank Nifty on 15-minute time frame of last 2 years, and you have a bullish pattern as an entry point. Now, bullish patterns, I've defined this system, and it is based on these 3 patterns. If one of these 3 occurs, then it's a entry point. Exit point is bearish swing breakout. Same way for short entry, there's a group of bearish patterns. You can check any pattern that we have discussed. The exit point, or the when we will cover, is bullish change of line, or if there is a 1:2. So these are the things we discussed, and now this is the outcome. So here you have the expectancy on 15-minute time frame. There are about 250 trades for Nifty. This till this point it's a bullish trade result, and till this it's a bearish trade numbers. So here it is a 0.23, which expectancy, which is positive, and it's very good on a lower time frame like 15 minutes. So the combination of these three patterns on Nifty and Bank Nifty is kind of profitable. It has got positive expectancy, and you'll see similar numbers for the stocks as well over this time.
Sounds good. Okay, so okay, sir, Akshat is asking, can you please explain once on the charts how to trade?
So for example, this is a 15-minute chart of Nifty. Now you see this pattern. It is a bearish. This is a series of three bearish lines, and you get this strong bullish line. So this is a bullish trend reversal pattern we can buy here. Okay, and then you have this bearish trend reversal pattern, right? You have this bearish swing breakout here. Here we can exit. It is also bearish shakeout because two lines and a bullish line and a bearish line. So here it is a bearish shakeout pattern. Here we can enter short. And then we have this rounding top, which is also a bearish pattern. So we remain in the trade. Then we have a bearish trend reversal. So we remain in the trade. And here it is a bullish swing breakout. So we buy here. So this is how we can, or after, another method is, if you have this bearish trade, you get 1:2, you book profit. You get a bearish trade, you get 1:2, you book profit. Here you get 1:2, you book profit. So that's how you can plan the trades.
Sounds good. Ganesh is asking, are line break charts repainting?
No, not at all. They don't repaint. It's a totally, actually repainting is myth. I think what a lot of people think repainting. For example, this is a 15-minute line break chart. Now this chart, this line will get locked only after 15 minutes, right? It's like candlestick chart. During that 15 minutes, this line will keep on changing. It will like the candle moves. If I plot a 15-minute candlestick chart, that last candle will keep on moving during that 15 minutes, right? And then next candle will appear. The same happens with line break chart. It's not repainting. The chart will move unless the time frame is complete.
Sounds good. So can you explain something on expectancy? Can you elaborate on the concept of expectancy?
So expectancy is basically how your system has done in the past. So basically, I'll go back to the formula and I'll explain. See, so this is an formula which I have worked on a lot of parameters on backtesting. So there are some statistical numbers, but I think this is something which is really good and workable. So if you have for example, your hit ratio is 50%. So that's your success ratio. Now your risk reward is, let's say, 1:2. So what happens is, in last 50 trades, you got 2 rupees, and the 50 trades that you lost 1 rupee, right? So 50 into 2 becomes 100, and then you deduct your failure ratio. You lost 1 rupee, so you minus that 50 points. So you get 50. So that's the money you made over in that system. So if your expectancy is positive, you actually made some money in that system. And that's so because the relationship between success ratio and risk reward is inverse. They are inversely proportionate, and for that reason I think expectancy can give us a very good picture of the performance of the system.
Okay, sounds good. So let me move further. Is it possible for you to explain this chart on this strategy on today's chart? A couple of examples if you can pick up.
Couple of examples. So this is for example, this is a today's chart. Let me just give you example of Nifty based on 5-minute, or this is today's session. You can see this vertical line. This is a day separating line. This is today's session. This is yesterday. and this is day before. Now the patterns that we have discussed, see, every change of line is actually your pattern. Change of line is what? Line change from bearish to bullish, then bullish to bearish. So here what happened is a series of bearish lines followed by a single a bullish line and a bearish line. So here this was a bearish shakeout pattern. What happened in the morning? There was a strong gap down, strong bearish line, right? When that happened, there was bearish, two bullish and a bearish. So this is like rounding top. This rounding top was that itself was a bearish pattern in the morning itself. Then you had a bearish shakeout pattern in the during the day, and then at the end of the day there was a bullish trend reversal pattern. So even if I buy here, during this entire day there were three patterns, 1, 2 and 3, right? And it was a happening day because there were a lot of lines during the day. Now let's before we discuss today, this was the session day before. So here bearish line followed by two bullish line and a bearish line. So in the morning you had this rounding top. This is your trade number 1. Then you had this strong bullish trend reversal line. So here you exit your bearish trade, you enter bullish trade, but your stop loss gets triggered when you get this bearish line. This is your bullish shakeout line now, and this is your trade number 3. Again you get a bullish trend reversal, then a bullish shakeout, and then a rounding bottom. So you had 4-5 trades in during this day. Now today what happened is there was a strong gap down, which was a bearish trend reversal line, and this is a rounding bottom pattern, right? Because bullish, two bearish and a bullish trade. So this was first. Then there were not many lines today during the day, so it was kind of narrow day later. So you had some narrow lines and then a bearish line followed by bullish line. So this is bullish shakeout and followed by bearish trend reversal. So these are the 4-5 patterns. You might have to practice it. If you just understand the rules, then you'll be immediately you'll be able to recognize it. But this is these are the patterns we saw on Nifty today. Now what happens is, if I can just apply some trend following filter like moving average or any other thing, I know if this is a downtrend, I will trade bearish patterns. If there's an uptrend, I will trade bullish pattern. So we can also filter our patterns based on the indicator or any other method of identifying the trend. But this is how we can identify patterns on the chart.
Sounds good. Okay, one interesting question by Mr. Paniraj Gupta is asking, what is a guarantee that the bullish pattern will continue after the trade has been initiated after bearish breakout?
There is no guarantee. We have seen the backtest. Sorry. Okay. So yeah. So we have studied the data and seen the backtested results, and we have seen that about 40-45% has been the hit ratio. That means your 50-60% trades will not work, but your risk reward is in your favor. So if you stick to the system, you end up making money.
Sounds good. Let me go on to the next question.
Yeah.
So some people say, sir, session is little heavy but interesting, but quite a lot of content to observe.
Yeah.
So
I understand.
All right, sounds good. So how do you compare them with Renko charts?
Renko is a bit different. Renko has a different property. The strong lines, which is drawn by connecting the two closing prices, the nature of Renko is a bit different. There you divide the price into fixed size bricks. So the riding method strategies or some of the strategies which are applicable on Renko chart are not applicable on line break chart and vice versa. So as I said earlier, I look at every charting method as an opportunity to design some different setups. Now what happens is, for example, if I am trading Nifty and instead of increasing the position size in the same system, my preference would be to have a different a kind of system which can complement my current system and trade based on that. So I found this charting methods very interesting here in this context, and some of the setups which are applicable on Renko chart, like trading based on moving average super trend on Renko chart. It's a wonderful method. Here what happens is I get these 4 line patterns which I will not get anywhere else, and that we saw the numbers that you have a lot of very small occurrences, but those patterns are very they have got very good numbers. So that objective setups I can trade based on these charts. So this is how I look at it. So there's no comparison as such. We trade based on बहुत selfish ban janega, trade based on the good points of every system. So that's my approach. And another thing is, see what I have discussed today, I know it is kind of bit heavy because it's a lot of it's a crux of lot of work that I've done on this method. And you might have to spend some time in understanding the patterns and practice a bit, but whatever I have discussed today is totally objective. There's no ambiguity. So if you just learn it, then you'll be able to practically implement it. That's what I can say for sure.
Sounds good. Can we use this concept on a 5-minute chart?
Of course, yeah, you can. This is a 5-minute chart only.
Yeah, Balachandra, you got your answer. Here is a question from Mr. Ram. He's asking, have you considered slippage brokerage taxes when you calculate the expectancy?
No, I haven't. It is a gross return, but because I was trading, I was studying the patterns, so I haven't considered the slippages. But we have seen the expectancy. They are capable. I mean, we can easily take care of the slippages. Those are there in the. Those are there.
Sounds good. Okay, let me pull out some more question. Ganesh, your question has been answered. Your question was, is line break charts repainting? It does not. That was the answer. Correct, sir? Can you elaborate on this?
Yes. No. Yes. Yes. Definitely, it does not.
Sounds good. Krishna is asking, does Espresso has this feature on line charts? No, I'm not sure. We need to check out with Espresso team. So today they have not come. We'll come back to you on that. Okay. So, okay. How do you calculate stop loss for intraday buys? Can you elaborate?
So stop loss for intraday. Okay. For example, I'll show it on your chart only. Now, for example, if no, let me, before I come to this, some other pattern. For example, if I buy here, this is the series of 3 bearish lines. You have a bullish line. So what is my entry price? Now see here, see this window. My entry price would be the high price, which is around 17,749. Then what will be my stop loss? Below this, the low of this, the lowest point of last 3 lines, which is somewhere around 17,698. So that will be my stop loss. Then we have to see, is this stop loss affordable to me? If yes, we can place a trade, right? Same way. Now in I'll give you another. So here in this case, my entry price is somewhere around 17,473. The lowest point is around 17,276. So it's a wide stop loss. If it is not affordable, we can skip this pattern and wait for that stop loss to be affordable and then only place a trade. Otherwise, just keep that thing. So that is how we can see. So whenever you're buying, see the lowest point of last 4 lines. That will be your stop loss. Whenever you're shorting, see the highest point of last 4 lines. That will be your stop loss.
Sounds good. Can I use this for long-term investments on weekly and monthly charts?
Yes, I've shown backtesting result also. They are very encouraging. So your investment methods can be, you can plan some wonderful trades on weekly and monthly time frame. I'll just open that slide again. So you have the weekly and monthly charts time frames are they have got encouraging numbers. So it can be a wonderful method.
Okay. Sounds good. How to calculate size of the individual line bar?
Actually, you can simply see the high and low price of that bar. No, first of all, you can just visually see if that it is a wide line or a narrow line, right? If it is a narrow line, you know the difference is not much. If you see a wide line, then you know that difference is there's a lot of difference, and then you can perhaps see the high price of the line and the low price of the line. That's your difference.
Sounds good. Any other indicators that work best with the line break chart, specifically for stop loss and target calculations?
Sorry, if you can repeat that again.
So over and above these charts, are there any indicators that can be combined for
Oh, okay.
better
Yeah.
calculations?
So there are uh, any indicator, of course, you can plot on line break chart also. So there are a lot of indicators. Actually, I've designed something like gain and loss indicator on this method, but I'll not talk about that. But maybe you can talk. You can apply this adaptive moving average, 40 line adaptive moving average. That can be a good trend, good indicator for filtration of the trend. And then I mean all other indicators are applicable on this method to which can improve the results.
Sounds good. So can we use this data additionally along with option data, volume, and open interest data?
See, of course, you can do perform all those studies along with what we have discussed. While backtesting, I haven't considered those things. See, my idea of backtesting these patterns is was that if they are profitable, one, if they are profitable, I can trade them alone and perhaps do well. Second is, if they are profitable, if I can filter my trades based on other observations and make more out of them. So maybe you can study volume, you can study option chain or open interest, and then filter your trades based on that. But what I can tell you for sure, based on my experience, if you trade these objective patterns and have some kind of filtration, I think your results will improve significantly.
Sounds good. Can this concept work on cryptos and gold?
Yeah, definitely. See, the best thing about technical analysis is they are applicable on any market. You just want OHLCV data, and you can just trade based on that. One. Second, I see amazing opportunity using noiseless charts on crypto. I mean, I can tell you for sure, the best thing is not a lot of people can use that because they don't know much about this subject. But if you study these subjects like point and figure, Renko, line break, they are kind of traders chart. You can see the trend, you can remove the noise from the data and see the clear trends, and they are really workable on crypto.
Sounds good. What is an adapting moving average?
Adaptive moving average is an interesting indicator that developed by Perry Kaufman. I've written a thread on Twitter explaining the indicator in detail. Maybe if you are there on Twitter, you can check that. You'll find it interesting. But it's a very it's an indicator which takes trend and volatility into account and change the curve of moving average based on that. So it's a very interesting concept. I use adaptive moving average at a lot of places instead of moving average.
Sounds good. Okay. Can we handle gap up and gap down openings effectively with these line break charts?
So the whole point is, see, first of all, no method, forget line break chart, no method in the world can tell you in advance whether it will be a gap up or gap down. So all that a trader can do is he should know how to react when there's a gap up or gap down. From that perspective, this chart can be very useful. For example, this is a strong gap down. You see this strong bearish line in the morning itself in first 5 minutes. So after, when that happens, either it is a continuation of bearish trend or it is a reversal. And here I know that it's a bearish rounding top. And if I'm using a trend filtration, it is below moving average line. So then I know how to know what is to be done. I can't really buy, at least here.
Okay. Okay. Dr. Hemant Narkade is trying on the same thing on Zerodha. He says Zerodha charts are asking to set price lines. What should be the value?
3. The only
Sounds good.
setting that any charting, any software will ask you to plot these charts would be the reversal. You see this reversal. So what we have discussed so far is 3 line break chart based on the 3 line reversal. Another interesting thing, I have a lot of patterns based on 1 line break chart as well. But that is for some other time. Right now, to implement what we have discussed today, your setting should be 3.
Can you tell the difference between point and figure versus this line chart?
They are totally different. In point and figure, you have column of X, column of O, and price remains in the column of X, and the price is divided between fixed number of boxes. So the size of every box is fixed. Same goes with Renko, but they are plotted diagonally. In the line break chart, the size of line is not fixed. It depends on the trend of or the difference between 2 prices. So from that perspective, all these charting methods are totally different, and they show us different patterns. And my interest is what pattern I see which I don't see anywhere else. For example, candlestick chart has some unique properties. You have shadows, you have a difference between open and close during the day and all that. I don't get that anywhere else. So there are some patterns which I can trade on candlestick chart, which I will not be able to trade on any other charting method. Same is with line break chart or point and figure chart for that matter. In fact, if people can be a little broad-minded and think beyond this comparison, then actually they will be able to make a better use of these charting methods.
Okay. So one quick question, Mr. Sharanaya Matpati says, does adaptive moving average available in Zerodha? Again, answer is we need to go and check there.
Yeah. So
do you think line break charts are better in identifying trends as compared to candlestick charts?
See, I actually avoid any comparison because that's a wrong thing, but yeah, from one perspective that you remove the noise from the data. So the lot of reversal which throws you out of the trade, you can filter them on the line break chart. So from that perspective, you can see kind of clear trend. You can just simply go on your candlestick chart and see the last 3 days. See on your screen you have 3 days data on line break chart on 5 minute. Now plot 5-minute candlestick chart of these 3 days. You'll get to know about the difference.
Can you kindly show an example, couple of more examples of bullish swing breakout?
Bullish swing breakout. Let me open some other chart. Let me see Bank Nifty. Now this is a daily chart. I'll also show on 60-minute chart. Bullish swing breakout is when price goes above the last highest point. For example, this is a bullish line. It goes above the last highest point. This is a bullish swing breakout. Now here you have this price goes above the high of this previous high. This is a bullish swing breakout, right? So that's how this is a bullish swing breakout. This is hourly chart. This is 15-minute chart. When price goes below the bottom lowest point of last several lines, here you have this bearish swing breakout. This is a bearish swing breakout. This is a bearish swing breakout. This is a bearish swing breakout.
Is it possible to automate this strategy by Krishna Shah?
Absolutely. I said that these charts are kind of algo friendly. All these methods are totally objective, so you can always automate this. There's no ambiguity.
Sounds good. Okay, so we can probably move on to the closing note
Okay.
if you are done with all the showing all the stuffs.
Sorry.
So, Prashant, thank you so much for the interesting session. I know this is quite a new topic for most of the investors. I think they might have to watch the recording of the video a few more minutes or few more
Yeah.
times rather in order to understand the intricacies of the subject. So, ladies and gentlemen, recognize the fact that Prashant Shah is one of the authors of these concepts. Definitely, there is no person in this country who would know this subject better. So please go back and watch the recordings again tomorrow when the recordings are available so that you'll understand the concepts much better. All right. Having said that, I'm sure this session will definitely help fellow traders to pursue this new concept of noiseless charts. Well, Prashant, on behalf of our media partner Money Control Pro, our title sponsor Espresso, the share count company, and my extended Traders Gurukul family members, I sincerely convey my regards for sharing your knowledge to all the participants of Intrazon 2.0. Thank you very much for being with us, Prashant.
Thank you so much. I totally enjoyed it. Thank you, entire team of Traders Gurukul and all the sponsors. And I hope that what we discussed today, people will find it useful and they will be able to use it in a better way. Thank you very much.
Brilliant. So friends, that's the story for today. We have successfully completed the 5th session of the Intrazon 2.0 program. I will see you all tomorrow at sharp 8 p.m. with yet another interesting session. Until then, signing off, Ashok Devanampriya from Traders Gurukul. Good night.